Good morning, everybody. We've just hit 3 minutes past 11. Welcome to our second quarterly economic and market update of the year. My name's Laura, and on the line I've got David Bassanese, our chief economist, taking you through today's topic, geopolitical risk returns. Now, before I do commence, all advice is general in nature, and should you require specific advice, please do seek out a financial advisor. Now, you will receive a recording of the session post-completion. It'll also be on YouTube as well. And just like every other time, if you have any questions throughout the session, please utilize the chat box at any time. We do have some time towards the end for Q&A. Now, if you know Betashares, you know we're active on all of our social media platforms that you can see here towards the right of the screen. And we also have the most read weekly insights bit from any ETF fund manager. So if you'd like to sign up for that, there's also a QR code on the screen. Now, just to surmise where Betashares is at, so as you can see here, we've got over $36 billion in assets under management. Our investors continue to grow. We've got now over 1 million investors in Australia. And as you can see, our product selection has grown as well, with over 95 different ETFs available for all of your individual goals. Now, in terms of where Betashares ended up for last year, we took the #1 spot, which is fantastic, at over $4.5 billion, which is 1 billion more than the second most inflows, which is a great achievement, but also a testament to ETF adoption more broader within Australia, which you can see is just where everything seems to be going. And just to visualize that as well, 37.5% of Australians have entrusted us with their investments, which is something we are really, really proud to have. So with that in mind, I will go ahead and pass to David Bassanese to commence the session, and I'll be back towards the end for Q&A.
Thanks very much, Laura, and great to be with you all as we move into the winter months of Australia. Hopefully not the winter months of financial markets, but I will, so I'm going to break up the presentation today. 3 elements, just a quick quarter in review, update on the outlook for the economy, and then what that means for financial markets. And as always, I've probably got way too many slides again, but I will try to get through it all, and may end up skipping over a few just in the interest of time, but we'll see how we go. But I'm going to talk up for probably another half an hour or so, and then we're going to leave time 10 to 15 minutes for questions at the end. So first and foremost, quarter in review, and just start with inflation. Again, you know, the big story globally is we need to get inflation back down to pre-pandemic levels, ideally without a recession. Central banks are, you know, working on that and hoping that can play out. And you know, we were fearing that we would need a global recession, would need an Australian recession to get inflation back down again. So far, at least, that's not panned out. Growth has been resilient, inflation's been coming down, but we have got a few speed bumps on the way. So you can see there, Australia's underlying inflation measure hit 4% year on year in the March quarter. It was a little bit higher than expected. The market was expecting this underlying measure of inflation in Australia hit about 0.8, came out at 1 quarterly increase. So the annual rate is 4. The RBA was expecting by June it would get down to 3.6, and so given it was 4, it would be hard to get 3.6% annual rate by June. So the statement of monetary policy that came out couple of days ago did upgrade the short-run inflation outlook in Australia. But again, you can see the projections there for what the RBA expects over the next couple of years. So the outlook is still for inflation coming down, though it's, I guess, in the short run, come down a little bit more slowly than expected. And I'll dig into the details of that a little bit later. In terms of the US, and so the key measure there is the core consumption, private consumption expenditure deflator, PCED. That hit 2.8% recently. So look, it's still on the way down, but a bit like in Australia, there's been some, you know, modest upside surprises with inflation in the US in the first few months of this year, which has had implications for markets. But bottom line, Inflation's still coming down, but though the rate of decline has been a little bit slower than hoped for in the first few months of 2024. At the same time, the real economy has held up pretty well, been resilient. So not only has inflation in Australia in terms of the March quarter been a bit higher than expected, we did get a very strong employment report a couple of months ago in February. If you look there, the unemployment rate in January was 4.1%, had just ticked over to 4. Then we got the January number and it slumped down to 3.8%, and that's where it sort of sits at the moment. So we had 100,000 gain in employment in February. We thought maybe some of that would pull back in March, but it didn't, and it held in. So again, the labour market in Australia remains pretty strong. Unemployment remains pretty low. Similarly, in the US, you can see there the unemployment rate. In fact, at the moment, the unemployment rate in both Australia and the US is similar, around about 3.8%. So that is the key macro news over the last few months. Inflation coming down, though not as quickly as hoped, and the labour market remaining, at this stage at least, pretty resilient. House prices, this is just a chart of what we're seeing nationally across the major capital cities. House prices are still moving higher. Nationally, we're looking at something like a 9% gain in house prices over the year to April. I guess a notable feature there is there has been some slowing in the major capital cities of Sydney and Melbourne. If you look at the grey line there, Melbourne house prices have levelled out in the last couple of months, and the rate of increase in Sydney has also slowed. But in the other states, the cheaper other states' house prices are still going up quite nicely at the moment. Again, surge in immigration, the shortages of supply, despite the RBA's interest rate policy, house prices have bounced back quite smartly over the past year, and the outlook is still for them to remain fairly firm going forward. Geopolitical risk, and now I titled the webinar Geopolitical Risk Returns. I mean, it was, a major development. Again, along with inflation surprising on the upside, economic growth holding up, particularly the labour market, the other major development over the past few months has been the escalation of tensions in the Middle East, in particular the tensions between Israel and Iran. Up until a few weeks ago, it was mainly Israel and in the Gaza, and that was quite limited. But then they attacked the Iranian embassy in Syria, took out a major military commander in Iran, Iranian military commander. Iran retaliated with a limited strike on Israel, and Israel. Then we had a bit of a tit for tat, and there was a lot of fear that would escalate. Now, ultimately, for financial markets, what they most care about is any disruption to oil supply. Iran is a major oil exporter, and in fact, they are subject to sanctions, but the world has been turning a blind eye to the increase in Iranian exports in the past couple of years because the world has needed that oil to keep a lid on oil prices. And so there was a big fear that if there would be escalation, those sanctions would be toughened, that supply of oil to markets would be denied, and it would put upward pressure on oil prices and upward pressure on inflation at a time when we're already still, quite concerned about the still high level of inflation. And you can see there that the first chart there is Iranian oil production, which has been lifting over the past couple of years. You can see for 2020, it's gone from 2 million barrels a day up to 3.2 million. So an extra 1 million barrels a day of extra supply from Iran over the past couple of years. Now, I guess the good news here is that since we put together the webinar and we promoted the webinar, I mean, as the tensions have, stabilised. The tit for tat between Iran and Israel has ceased. Israel did sort of do a counterattack on Iran. Very limited in scope, and Iran basically sort of downplayed it, said, "Oh, it wasn't very much. It didn't do much damage. They were just trying to find reasons not to have to continue the tit for tat." But that seems to have ended for now. which is, at least one piece of very good news for, I guess, the region in general, of course, just through we don't want to have wars escalating, but also from a financial market point of view, we've seen oil prices pull back a little bit since that hasn't escalated. So we need to keep watching all of that. But again, just to reiterate, the good news at least is that those tensions have stabilised, and both sides, don't see any interest in escalating that into a full-blown war. I mean, it just would be a terrible situation were that to pan out. So, fingers crossed that remains the case. What does all this mean for interest rates? So I've got a chart here of, this is the futures market expectation for the RBA cash rate on the left, and for the US federal funds rate on the right. And you can see there let me get this right. So in the sort of red line is what the markets are expecting at the end of last year. And you can see the markets are expecting, quite decent rate cuts in Australia by the end of 24, something like, 2, possibly 3 rate cuts in Australia. And would you believe in the US, very aggressive rate cuts, something like 6 rate cuts were expected through the course of this year. You can see that as of the green line, the latest situation has been in Australia, the markets have fully priced out expectations of rate cuts. And in fact, there's a small probability, something like 20 to, 50, well, actually closer to 50% now, 50-50 probability that the RBA could actually raise rates one more time this year. Most economists don't anticipate that, but the markets are just pricing in, some risk of one more rate rise. So we've had quite a sea change in rate expectations, as you can see. And the black line there is where we were at the time of the last webinar back in mid-February. So since mid-February, it's been quite a notable shift up in terms of rate cut expectations, or ruling out. And also in the United States, you can see there the markets have gone from expecting 6 rate cuts this year to now 1 rate cut, 1, possibly 2, but certainly at least 1. But then more rate cuts are kicking in 25. So they do still expect rate cuts, but more likely to happen in 25 than 24. So that's had an impact on equity markets, had an impact on bond markets. And why is this? Again, I go back to the upside surprises we've seen on inflation and the continued resilience of economic growth. I mean, markets have just concluded, we don't need to cut rates as quickly as we thought we were going to get. And so they've adjusted accordingly. So what does all this mean for financial markets? You can see there, since the end of the March quarter, we've had a bit of a pullback in equity markets. So you can see the US market peaked around about the end of the March quarter, and it's had a bit of a pullback there. On the back of, as you can see, 10-year bonds grinding ever higher. Now, 10-year bonds in the US are now up over 4.5%. They did reach 5%, or they touched 5% late last year. So we're not back to those peak levels, but certainly over the course of this year, as you can see, we've had quite a notable retracement in bond yields as those rate cut expectations have been priced out of the market. Also associated with that, the US dollar has strengthened, and again, adding to the inflationary pressures, at least up until recently, has been that rebound in oil prices. You can see oil prices late last year around about $70 a barrel. The increase in Middle East tensions, we've seen them break over, at one point they hit $90 a barrel, but they've pulled back a little bit more recently. But that's, again, a snapshot of global markets, a pullback in equity markets on the back of higher bond yields. In turn, that has strengthened the US dollar because interest rates in the US are likely to stay higher for longer, which is attractive for people looking to, invest in to pick up interest rate yield. And oil prices have been just, adding to the inflationary angst so far this year. But good news, at least recently, is that we've had a bit of a pullback with the stabilisation of the situation in the Middle East, at least as regard Israel and Iran. I mean, unfortunately, the situation in Gaza is still very fraught, but that, at least from a global financial market perspective, is fairly contained in terms of its impact. In terms of Australia, so this is the story here. So our market, we had a very nice breakout in the Australian equity market In the first quarter of this year, we broke up over 7,500. Our market's been in a sideways range for a couple of years, so that was a very nice breakout. But along with global markets, we've had a bit of a pullback so far in the June quarter since the end of March. Associated with, as you can see, bond yields moving higher. Aussie dollar, unlike the US dollar, has generally weakened in this period because of the strength of the US dollar. Another interesting thing is through the course of the first quarter, we had a big slump in iron ore prices, fear about the Chinese economic outlook. There's a bit of excess inventory building in terms of iron ore, but we've had a reasonable rebound in the iron ore price of late. It's back over $100, in fact, touching around 120. So optimism with regard to China is improving glacially, as I expected it would a few months ago. I thought there was excess pessimism about China. So things are improving. Their equity market's also starting to rebound, as well, as I'll get into a bit later. But that's been the situation with regard to iron ore. What does this mean for asset class returns? I've just got a summary there of, you can break it down into defensive assets and growth assets. And you can see, at least over the past month, we've had quite a notable pullback in equity markets, and we've had some weakness in fixed rate bonds as well, Australian and global bonds, because when bond yields go up, the value of bonds, the market value of bonds goes down, and that hurts the return on them. So on a 3-month basis, you can see bonds have been down. Equities on a 3-monthly basis are still up, and certainly on a 6 and 12-month basis, comfortably up. But just in the last month, we've had a bit of a pullback there. Within the equity market, so this is just looking at within the equity market some different sort of thematics. So you can see their growth versus value. So these are companies with above average PE ratios, typically things like technology, consumer discretionary, versus value sectors, things like financials and energy. Associated with the rebound in bond yields, we've seen growth pull back relative to value. We've seen the US underperform relative to other developed markets, particularly Japan. And as I noted, we've seen emerging markets have a bit of a bounce back in the so far this quarter, with some optimism in China in particular returning. So a bit of a shift from the normal patterns that we've seen. I mean, the last few years it's been the US, it's been technology, it hasn't been value, it hasn't been emerging markets. The one thing that hasn't yet kicked in is a sort of rotation back into small caps. You can see there, they're still sort of, in terms of relative performance to large caps, still sort of biding time there. But again, just in summary, the rebound in bond yields has been associated with a rotation, if you like, out of growth, out of the US into value and non-US markets. On top of, that's one element, the bond yields, but also just some recovering confidence with regard to China. China's market's been beaten up for a long time. Emerging markets look relatively cheap, and so despite a stronger US dollar, it's been interesting that emerging markets have had a bit of a bounce back here. Just look, I won't go through this a lot, but this is really I'll let you maybe go through this at your leisure, but this is really a breakdown of global equity markets by regions, by sectors, and by factors. You can just see the pullback that we've had in the last month. On a 3-month basis, though, everything's still nicely in the green. And on a longer term basis, it's still been the technology area, the US market that have been outperforming. The other one there I just would point out is how well Japan has been doing. Very strong returns over the past 12 months, 35% return. You can see technology by sector, technology is still the leading sector on a 12-month view, though it's had a harder time just over the past month. And in terms of factors, things like quality, growth on a 12-month and even a 6-month view have certainly been the stronger performers. But again, they've had a bit of a pullback in the short run. And that's been reflected in some of these are all the different ETFs that we have, broken down by sectors, broken down by regions, and also the Australian market broken down by different ETFs as well. So just a couple of things to point out. Look at HJPN, the Japanese one, up 56%, would you believe, on a 12-month view. Certainly pretty strong returns over the past 3 to 12 months. Globally, it's still been things like quality, HQLT. These are companies with above average return on equity, and the NASDAQ, and some of the more defensive areas are not as well. But again, that has been the longer term view, but just in the short run with the backup of bond yields, we have had a rotation out of those areas and into some of the value areas. Something I'd just point out in terms of Australia, interestingly, if you look at ATEC, many people, there is an Australian technology ETF. Everyone focuses on the NASDAQ, but we have a small but thriving technology sector in Australia, and we capture that through the ATEC ETF. And that's up a nice 33% over the past year versus only a 9% return for the Australian market. So, NASDAQ is great, but if you want some homegrown technology stars, something like ATEC is, potentially something to look at as well. And you can see financials have been doing quite well as well, up 19% over the past year, 21% over the past 6 months. Resources not so well with the pullback of iron ore, at least up until recently, and some of the pessimism around China. Quality, so we do have an Australian quality ETF as well, companies with above average return on equity. That's been up 21% on a 6-month view, 15% on a 12-month view. As we've seen globally, smalls have done okay, but not fantastically at the moment. We do have a small cap ETF as well. So again, just to give you a broad idea of some of the different exposures that we offer across sectors globally and regions, and even within the Australian market, you can play the Australian market from a sector perspective using ETFs as well. What about the economic outlook? So this is something I had back in February, where I broke up the scenarios in terms of soft landing, overheating, recession. I had a 60% probability on a soft landing, which is, avoiding recession, growth slowing moderately, but not by a lot, and importantly, inflation continuing to come down. The bigger risk was that if growth would stay, too strong for too long and inflation wouldn't come down as quickly. I still believe that, but this is my updated, I guess, subjective probability. There's a higher probability if you go back to here. So I've increased the probability of overheating from 20 to 30%. I've reduced the probability of recession from 15 to 10 because, growth is being resilient. And soft landing is still a highest probability, but somewhat less than in February. So that just gives you an idea of the shifts in the wake of the data that we've been seeing in terms of the outlook that I'll get into now. So why do I still believe a soft landing, is still happening? I mean, some economists are talking about rate rises, talking about resilient economic growth. I mean, I still think there's we are on a good path here. I mean, not without risk, but we're on a path where we can go back to the pre-pandemic levels of inflation gradually, without the need to go into recession. Now, first and foremost, if you look at the US labor market, job vacancies in black are still coming down as a share of the labor force. It doesn't have it labeled there, but that's job vacancies as a share of the labor force. Not quite back to pre-pandemic levels, but getting close. And if you look there, the unemployment rate just before 2020 was similar to where we are today. So we're from a job vacancies unemployment rate, we're sort of getting back to close to where we were prior to the pandemic. And importantly, prior to the pandemic, inflation was quite contained ultimately. So that's sort of what I'm still counting on will play out. Helping, and why is this happening? Job vacancies are falling, not because demand for labour is drying up, it's because there's been, a rebound in supply, and so there's been, more workers prepared to fill those job vacancies, so businesses haven't had to bid up wages to attract workers because of that positive supply response. And you can see that there, the very solid rebound in labour force in the US over the past few years, and it's more or less continued through this year as well. And as you can see here, various measures of wages growth. This is, again, regular, viewers of these webinars. To me, this is the most important. This is the difference between soft and hard landing for the US economy, and also then for the global economy and Australia. If wages growth in the US can come back down without the unemployment rate needing to go a lot higher, happy days, because then we can get inflation under control and we can avoid a recession. You can see the various measures of wage inflation are still coming down, still a bit above where we were prior to 2020, but certainly at the moment the trends are still moving in a good direction. So that is continuing to remain quite encouraging. We did get an upside surprise on the wage cost index in Q1. Q1 was a bit of a strong, generally speaking, a strong economy. Growth has slowed a little bit less, and certainly the average hourly earnings measure of wages, the orange line, in the latest payrolls report was quite benign again. So I would discount a little bit the signal that we got from that quarterly wage cost index, and I would anticipate that would continue to ease through the course of this year. But there's something I'm watching very closely. Certainly we don't want to see these no longer falling, and certainly we don't want to see them rebounding and going higher, because the picture for financial markets would change. Central banks would have to, the Fed would have to be more aggressive and have to almost guarantee a need for the unemployment rate to move higher than it is at the moment. The other, I guess, confidence is when you look at US inflation, you break it down into the various components. You can break it, really, this is core PCE. Again, you can see it's under 3% now, it's at 2.8%. I've broken it down into the three areas: core goods, core services, and housing. I've got an index there, and I guess with each of those, some of the key drivers of inflation in each of these areas. So in terms of goods supply chain pressures, these are things like cargo rates, delivery disruption times. There's an index that covers, it's like a summary measure of supply chain disruption, if you like, and you can see that is pretty benign. It obviously surged in 21, 22. It's come back down and hasn't bounced back. So despite some of the disruptions, you might have heard about the Red Sea disruptions, the overall supply chain story for goods is still pretty good, and goods inflation is remaining fairly benign. Housing, house prices with a lag flow through to housing inflation, and you can see that the surge in housing inflation in 20 and 21 flowed through to inflation in 22 and 23. House price inflation has since come off, and with a lag that should continue to flow through to housing inflation in the US. That's rents and housing construction costs, but particularly rents. And we do know that rents on new leases are still relatively benign, and that should flow through. Now, one of the upside surprises with inflation in the US in the last few months has been housing rents. It's been a bit of an anomaly because they've been a bit firmer than you would expect given what we're seeing in the actual rental market. So the flow through to the official measures of inflation haven't been as much as one would expect. But I think we would anticipate that would resolve itself, and housing inflation will continue to come down. Last but not least is core services, and you can see that is still trending down. And I've got a composite measure of wages growth, which, as I showed you earlier, is still trending down. So again, the trends are still moving in a good direction, which I think still bodes well for inflation coming off again. So if you break it down into all the three major components, I'm not seeing any major red flags here. Oil production, so again, oil prices have gone up, they've come back down again with the Middle East tensions easing. I pointed this out last time. US oil production is still pretty firm, and so that should help create a limiting effect on oil prices once Middle East tensions, assuming they continue to stabilize. And also OPEC themselves have capacity to increase production if need be, because they've been artificially restricting supply in the last couple of years. What about Australia? Now, I've broken down inflation in Australia into some of its key components, and these are my own breakdowns, actually. So there's 120 individual items in the CPI, and you can allocate them in various ways. I don't like the way the ABS do it. I've done it in what I think are more reasonable measures, and I've got core, which are goods and services, core goods and services. Non-core are things like non-market services, things like education, health, electricity, things that aren't really driven by the market. And housing is also part of the core CPI. You can see that both of them have come down. They are still above, well, certainly the thing that remains above pre-pandemic levels at the moment is the core CPI in orange. You can see prior to March 20, it was running at only 1%. At the moment, it's running just under 4%. So it is true that the inflation we're seeing is in the core area, not in the non-core area. Non-core inflation's generally been pretty high for a while. So the fact that it's running at 4% at the moment, not too dissimilar to what we saw prior to the pandemic. But it's the core. Now, if you break down the core into housing, these are things like rents and goods and services. You can see that the two key sticking points in Australia are still housing, particularly housing rents and services. So things like insurance costs, that's part of services. A lot of discretionary services, retailing, hospitality, these areas, hairdressing, all these sort of areas are still showing sticky prices. Now, I think part of the service inflation is a flow through of cost pressures, which are still working their way through the system. But it is also true we've had some major wage increases, certainly for lower income households through the minimum wage increases. And a lot of those workers tend to be in the hospitality area and in the care areas, which are part of that services inflation. So there are reasons why in services inflation does remain sticky. But again, I think it is coming down, albeit not as fast as we were hoping. But again, I think a lot of these cost increases, once they flow through, again, we're not going to get an 8% minimum wage increase again. It'll be a lot more benign next time around, and that should start to moderate. Housing rents is a sticking point, but again, what can we do? We've got housing shortages. We've had a major increase in immigration. And that housing shortage is causing all sorts of problems in the rental market. The RBA, it is inflation. They've got to be conscious of it. But, funnily enough, higher interest rates would probably make that problem worse, because it would make even more first homeowners not be able to afford to buy a home, and they'd be forced to go to stay in the rental market and actually tighten the rental market up even more. So, but that is the situation as it is if you break that down. Good. I won't go through this in detail, but I've broken down all the various components of inflation in Australia. What I've got there is the annual rate as at March versus the average rate of inflation in the 2 years prior to COVID. And you can see in the 2 years prior to COVID, inflation was 1.8%. In the year to March, it's 3.6. So that's a difference of 1.8. Now, where are the big what's causing that? Core services account for 0.7 of that. And if you dig into that, you can see it's financial services, which is insurance. Now, even insurance, you could argue, is not really a demand-driven thing. We've got, climate change. We've got higher damages due to, erratic weather patterns that have caused insurance rates to go up. And that is, that is a cost of business, but it has been reflected in inflation. You can see some sticking prices in areas like restaurants and takeaway as well. But again, I think that's going to start to die down in the same way. You can see it's already died down in holiday and travel, which was a big source of inflation a year ago, but now that's died down. The other sticking point is rents, as you can see. So annual rents over the year to March was 7.8%. In the 2 years prior to the pandemic, it was actually running at 0.5%. That's about a 6% weight in the CPI. So that's added 0.4 to inflation, 0.4% of that 1.8% increase. So look, there's a few other things going on, but it's really, again, core services and rents are the key sticking points as keeping inflation at the moment higher than what we saw prior to the pandemic. But apart from rents, I have more confidence that services inflation is going to start to continue, to ease, and those cost pressures will start to wane. Market implications. Just got a little bit of time to go. Again, a slide that I've showed you before. This just breaks down different ways to play the market for different market environments. So again, if you believe in a soft landing, if you think growth is going to remain okay and interest rates aren't going to go up a lot more, in fact, central banks will eventually cut rates, technology, growth type of exposures, things like the NASDAQ, things like the Australian technology ETF in Australia, ATEC, the Asian technology exposure as well, Asia. These are, things that, as you can see, over the past 6 to 12 months have done very well. They've had a pullback of late, but if those interest rate concerns do die down again, I think they will come back to the fore. Now, if you have a different view, if you think we're going to have overheating, but you think equities are going to hold up, but interest rates are going to go higher, then you want to go into some value types of exposures. Japan is one. H100 is the UK market. It's a defensive market. We've got an equally weighted US exposure as well, QUS. It's still the US market, but it has less exposure to the top-heavy technology companies. If you fear a recession and central banks are going to slash rates, you want to be in fixed rate bonds, and we have a lot of different exposures there, AGVT, GGov, US 10-year government bonds. If you fear stagflation, if you fear inflation's on the way back up and it's going to be a commodity boom, then gold, QAU is an interesting option, but also just hunkering down in cash, something like AAA, which is our ETF that basically invests in bank deposits. And also UTIP is the inflation protected US government bonds. So different ways to play the market. I have two views. I think the top part of this area could do well. I mean, I think I'm still in the soft landing camp, but one thing that suggests some of those areas in the overheating area could also do well is that they're relatively cheap. So even if we get a soft landing, we might still get the value parts of the global market at least catching up to the rally that we've seen in the growth parts of the market, because on a relative basis, they do look cheap. Rate cuts, I've still got rate cuts coming. I've got one rate cut now in Australia this year and then one more early next year. Now the markets have shifted a little. You can see there the markets are, not really pricing in aggressive rate cuts anytime soon in Australia. In fact, since I put this slide together, there's been a shift in the markets on that front. And bond yields, I still think, we've had a backup, but I do think they're going lower. And I still think 10-year bond yields in the US, which are now around 4 and 4.6%, I think can get to 3.5% by year end. So bonds are presenting value if you don't believe we are on the cusp of further significant rate rises, as I don't believe that we are. Aussie dollars had a pullback, and again, as we move, as we do eventually get to the Federal Reserve in particular talking about rate cuts, I see the Aussie dollar moving higher. But as you can see at the moment, it's had a pullback this year because of those reduced US rate cut expectations. Equities, I think, can continue to grind higher. If you look at the PE ratio for the markets, it's broadly in a fair value range. The US market looks expensive. Non-US markets look cheap. Overall markets trading at 16, 17 times earnings, particularly given the pullback we've seen in the last few weeks. It looks reasonable value. Earnings expectations are still positive. You can see forward earnings are still grinding higher, which bodes well for the market as well. The equity risk premium, you can see the lower right-hand column, does look tight from this perspective of the last few of the past decade. But I actually think that is partly reflective of the high level of interest rates, because if you look where bond yields are today, US 10-year bond yields at over 4%. The last time they were at over 4%, the equity risk premium was also pretty tight. So I think that part of the reason it's tight is that bond yields are high and the markets don't anticipate they're going to stay high as they are. So that's the markets are sort of discounting that a little bit. But overall, it's not a red rag here. So valuations per se, I don't think are a major risk. It's more, if inflation does remain sticky and central banks, heaven forbid, have to actually start to raise interest rates again. But for the reasons I went through, I don't anticipate that. But that's a state of play with the global equity market at the moment. And I mentioned this before, Technology, as NASDAQ has a lot of tech companies, has a lot of growth companies. It's trading at above average PE valuations, not by a lot, nowhere near what it was in the dot-com bubble, but as a relative valuation, I mean, it's looking, the rest of the world looks relatively cheap, and maybe that valuation gap can close. You can see it has started to close a little bit of late with the backup of bond yields. But I think there is, I guess, like what I'm saying here is there is value in the non-tech parts of the global market, and even in a soft landing scenario, maybe they can continue to catch up. Just summarize, I mean, I went through this before, but this is just in regions. You can see so far this year, we've had a bit of a pullback in the US, long-term outperformance, bit of a rebound in emerging markets. Japan's going from strength to strength. We've had a bit of a rebound in Europe as well, which has been interesting. And again, I think, we may see that continued catch-up performance by non-US markets in terms of regions. If you look at various factors, growth has had a pullback, quality's had a pullback, value's had a bit of a lift, and then if you go by sectors, technology has had a pullback in place of energy and banks of late. So again, as I said earlier, it's been a rotation to value out of growth, a rotation out of the US into non-US, and that may still continue to play out even if bond yields stop going higher on a relative valuation basis. I will leave it there. Just in terms of Australia, the last slide, and I'm right on time here. I'm very happy about that. So this is the Australian, one area that hasn't, had a rebound in terms of performance, sadly, is Australian market. You can see here, more or less, we've been on a downtrend since the GFC, since the rise of the tech boom #2, as I call it, the rise of the FANG stocks, or now the Magnificent Seven companies. We did have a brief period of outperformance in 22 when Russia invaded Ukraine and commodity prices and gas prices went up. That's been unwound and it hasn't come back yet. On a relative basis, our market does look cheap to global markets, particularly the US market. That's the big chunk of that. But at the moment, that valuation signal, or that value has not been reflected in terms of relative performance at the moment. But we'll wait and see if that can turn around, but that's the situation at the moment. I will leave it there. Things to consider, the usual disclaimers. Again, all of our ETFs, 95 of them, as Laura mentioned, we all have product disclosure statements and information for each of them on our website. I reiterate what Laura said, this was just general information, certainly not personal investment advice in any way. And I'll open it up for questions.
Thank you, David. And that was a fantastic session. We've had a record number of questions come through, and I'm sure we won't be able to answer all of them in these last couple of minutes. So I'm sure we'll send over some responses after the session. But some key trends here, David. You mentioned the cost of living is rising with things like groceries and insurance, and the rental market continues to price out younger individuals, and finding a rental is just not getting any easier. Why is the government allowing record numbers of immigration in the middle of this crisis?
Look, good question. I don't want to be too critical of the government, but I would say we massively dropped the ball on the immigration front over the past couple of years. We all favour some degree of immigration, where immigration dried up during COVID. And so a lot of people, there was a backlog of immigration visas that needed to be processed. But, I don't think it was warranted to allow 500,000 people to come into the country in 1 year, double the normal rate, and then that to continue. I think most economists, if you candidly ask them, said that was a policy mistake. Could we have controlled it better? Maybe. I'm not sure, but I think with hindsight, that was a major dropped ball, if you like, by the government. We should have managed the rebound in immigration better. It's helped on the labour front, like a lot of the supply, a lot of the labour market. It's had mixed implications in the sense that it's helped redress some of the labour shortages that we've had. Suddenly you've been able to find a waiter or a waitress at a cafe. for example, but it's obviously added to pressures in the housing market. But yeah, so I don't have the answer, but I think, with hindsight, we might have tried to manage that a bit better than we did.
Thank you, David. And so another common trend.
Sorry about that. I'll just make one other point about the housing market, which I haven't mentioned. I mean, really, if you want to summarise what's going on in Australia at the moment, growth has slowed. It's been mainly driven by consumer spending. So consumers, households have really been under, taking it on the chin, and they have been weakening their spending in the face of a pretty substantial cut in household real income due to inflation, due to higher interest rates, due to the increased tax drag through last year. But infrastructure spending has been booming. And not, and you just have to look around capital cities. You see and even in the regional cities, state governments and have been spending big on infrastructure projects, and that has been drawing labour and materials away from the housing sector. So it's not just the immigration rebound that's added to the housing pressures. Would you believe, despite the shortages of housing building approvals and housing construction is in the doldrums because A, affordability due to high interest rates, but B, it's very hard to get skilled labour into the housing sector because they're all being drawn into building toll roads and train tracks and these sort of things. So it's a combination of those things. So again, with hindsight, the bunching of infrastructure and the way that it's happened, and it's hard to manage these things, I guess, to get the timing of it right, but they've all come at the same time. We've had a major immigration rebound, and we've had a major infrastructure boom, which has squeezed the housing market. And as a result, we're seeing it in house prices and we're seeing it in rents.
Thank you.
Sorry, Laura.
No, that's okay. I appreciate more insights, even as for a young person myself. And so I'm sure you're not too unfamiliar with the election happening and all the questions we're getting around there, but this one's, I think, very interesting. How will the US election impact markets specifically on the individual parties' intentions towards geopolitical tensions and what those different parties support?
So by election, I think you're referring to the US election. We've got an election, but probably not till next year. Look, I think it's still up in the air whether Donald Trump's going to come back or not. I mean, at the moment, the polls are pretty close. Anything can happen during the election campaign. But look, bottom line, I think financial markets are comfortable with the return of Donald Trump. I mean, in the sense that he is pro low taxation, pro low regulation. Markets rallied nicely during his previous term. The two concerns with Donald Trump and even with Biden is the fiscal deficit situation. The US is running a budget deficit of 6% of GDP at a time of record low unemployment. So the so-called structural budget deficit in the US is enormous. Fiscal spending over the past couple of years has really contributed to the resilience of the economy despite higher interest rates, and as a result contributed to the stickiness of inflation. Under Donald Trump doesn't care about the deficit. He probably cares less about it than Joe Biden. So there is a risk that the bond market finally says enough is enough, and we get a spike higher in bond yields and forces the US to do something about the deficit. But it's hard to foresee when and if that would begin, but I just pose that as a risk that we'll see. And the other one, of course, is renewed tensions with China. But again, that's more of a concern for China than the US market. If there are higher trade, tariffs placed on China, I think that's a reason to be wary of the Chinese market. But as we saw in the past, it would only have a fleeting glance, a glancing blow, if you like, in terms of Wall Street, because it's more important. It would have bigger negative impacts on China than it would have on the US economy.
Thank you. And another one we're often getting, what do the delayed rate cuts mean for S&P 500, and is now a good time to invest?
Yeah, well, what it means is that we've had a pullback in prices because, you know, bond, you know, and I guess what happened, so the story this year is that bond yields, we had a few upside surprises in US inflation in January and February. Bond yields moved higher. They started to price out rate rises, rate cuts. The Federal Reserve, up until recently, was saying, oh, we think this is speed bumps in terms of inflation. We still think inflation's coming down. We still think we'll be cutting rates later this year. And then we got the third higher than expected inflation report in the US, and the Fed said, you know what, we've got to acknowledge this. And so the Fed themselves shifted their rhetoric in the last few weeks. Jerome Powell said, you know, we don't have confidence that inflation, we don't have more confidence that inflation is coming down, so we're probably going to cut rates less aggressively than we said we would. In the last statement by them, that they said they would cut rates 3 times this year, not the 6 the market expected, but at least 3. Now that's looking like 1, possibly 2. But equity markets have pulled back. But so look, we're in the midst of an equity market correction. We're not at record highs, and that could play out for a little while longer. It could get deeper. But you know, we're in the hands of the inflation numbers. If they start to moderate, and markets can get confident that we definitely won't get US rate rises, then, you know, a 5, even 10% pullback in the markets, I think, would be a good buying opportunity, because, you know, I don't see a recession on the horizon. But look, timing pullbacks is, you know, it's not for me to say the market's going to drop another 5% in the next 2 weeks and then I would buy it. I'm just telling you the broad situation at the moment. I don't see a recession, hence I don't see you know, a major bear market. I do see, and I think inflation is eventually going to get better again after having been a little bit disappointing. And I don't see the Fed or the RBA raising rates. So I think we reaching the limit in terms of how far bond yields will go, and potentially the limit in how far equity markets will sell off. But I can't really be any more precise than that.
Thank you. And thank you all today for joining the session. A few of you have asked if there will be a recording. Yes, you will receive the recording. It'll also be available on YouTube as well. And we've received an absolute influx amount of questions, which we will aim to have them answered and sent post-completion. We do love answering your questions and being a part of what's happening in your world. So I guess thank you all for joining, and we'll see you all next quarter.
Okay, bye for now.